The New Normal, Part 6A, Past New Normals, Objective. As the world works through the global pandemic, the word unprecedented has been used to describe the current environment by the vast majority of companies in their first quarter earnings report. Very few would argue that the synchronized global economic slowdown, or shutdown, is indeed unprecedented. There is very little doubt that some things will never go back to the way they were before COVID-19 entered our life. We are just not sure what those changes are just yet. Over the last 30 years, we have seen three other events that, at the time, had a similar feel about a new normal, or a realization that some things will never go back to the way they used to be. The first event was Y2K, the second was in the aftermath of the September 11th terrorist attacks, and lastly, the 2008 financial system collapse. These times, we were left to speculate how the world would change and how those changes would alter how we live our lives. With the hindsight of time, we can now look back and see what predictions turned out to be true changes, the ones that were more short-term in nature, and predictions that were just plain wrong. This may give us the ability to view current events in a little bit of a different light. First off, Y2K. While almost comical 20 years later, the anxiety over the Y2K, quote, crisis led to some fantastic predictions. People were scared airplanes were going to fall from the sky, prison doors would swing open, financial corporations were doomed to collapse, and utilities would fail. As a result, folks hoarded bottled water, canned food, toilet paper, does that sound familiar? And ammunition as we neared New Year's Eve. Then on January 1st, 2000, the world didn't end. The sun came up in the east in the morning. Our pantries were full of food we didn't really want to eat. Essentially, nothing happened. Or did it? The late 1990s saw a massive boom in the technology sector, and specifically internet, lovingly referred to as .com stocks. As we got closer and closer to Y2K, U.S. firms upgraded their computers, hardware, and software to prevent Y2K issues. Companies which sold computers and tech equipment had incredible sales growth, with a massive spike in the fourth quarter of 1999. Unfortunately, analysts used these numbers to make growth projections which simply weren't realistic. While I don't remember hearing the phrase new normal at the time, I do remember folks saying, this time is different. As a result, the technology-heavy NASDAQ index soared in late 1999, moving up from 2,600 in October of that year to 5,100 by the end of March 2000. As the year unfolded, something became readily apparent. Folks weren't upgrading their technology equipment. Well, why would they? They had just done so to get ready for Y2K. Not surprisingly, in hindsight, by the end of the first quarter, companies were giving earnings guidance which were a fraction of analyst estimates. This is when the markets realized corporate America had essentially crammed 7 years of technology-related capital expenditures into 3 short months. Regrettably, again, Wall Street had focused the incredible growth rate at the end of 1999 as a sustainable new normal. It wasn't. It would take several years before the industry could recover and see demand for computers and peripherals return again. Also, all those consultants which companies hired to be part of their corporate Y2K teams were no longer needed. These things led to both the .com stock market crash of 2000 and the recession of 2001. The NASDAQ index would fall from a high of 5,132 in March of 2000 to a low of, get this, 1,108 in October of 2002. It would take more than 15 years for the NASDAQ to reach 5,100 again. Clearly, it was not different this time. Then there was September 11th, 2001. As we entered September of 2001, the U.S. economy was already slowing, and many were calling for a recession, similar to this year. There is very little doubt that as we watched the news for updates back in the days following that date, that we were in a recession. Some of the new normal predictions included air travel was the low-hanging fruit of change predictions after 9/11. Security screening was going to dramatically increase, and it would take people quite some time to get comfortable flying again. Today, most travelers expect to be asked to remove their shoes, belts, watches, etc. A few complained about the enhanced security measures at the time, but that increased security allowed travelers the confidence to return to flying sooner than most would have predicted. Those enhanced screening measures are still in place today, little changed from late 2001. Another prediction was we would see a prolonged drop in consumer confidence. and most consumers would tighten their purse strings and reduce spending for years. While consumer confidence numbers did in fact drop after 9/11, it was relatively brief, and spending was, well, little affected. Reduced consumer expenditures, coupled with increased government spending on the spending on the pending war in the Middle East, would reduce the growth rate of the economy for an extended period of time. GDP growth did fall in 2000 and 2002, but by 2003 we were back to 3% plus GDP growth. Another expected change was the tightening of the borders, both north and south. For a few years after the attack, the borders to both Mexico and Canada were indeed tight, and long delays were the norm. This border tightening did not last forever, and the borders became even less restrictive eventually than they were prior to 9/11. Interest rates fell to a multi-decade low, with the 10-year U.S. Treasury note falling to a low of 4.3%. At the time, we thought it can't fall much more than that. We must be at the bottom floor of interest rates. The weeks and months after 9/11, both Democrats and Republicans worked together, and there was hope for less partisan politics as we move forward. Never mind. The 2008 financial system collapse. The housing market would take decades to recover, and the reduction of equity for homeowners to tap will be a headwind to economic growth. This was really, in large part, kind of correct. The housing market has recovered, but never quite close to that frothy levels of 2000 to 2006. Back before 2008, it was not uncommon to have a borrower receive a loan for 100% of the equity with no proof of income. The thought in late 2008 was that we will never see those days again. To this point, well, that's still the case. Banks have become very aggressive in pricing loans to well-qualified buyers, but the 80 to 85% loan-to-value ratio is more the new normal. In 2008, the government was forced to pick winners and losers. It was not possible for the government to step in and save all failing companies from insolvency. For example, AIG was saved while Lehman Brothers was allowed to fail. Many believed that this would set the precedent for future recessionary events. That prediction also seems to be holding form, with current sectors that are deemed to be more vital to economic recovery likely to get assistance from the government. You can think the airline industry relative to the cruise industry. In the aftermath of the near failure of AIG, many thought that cash flows into annuities would drop, as the guarantees from a company in bankruptcy does not mean much. That projection did not materialize. The government bailout of AIG prevented that risk from entering the headlines. Now many insurance companies use subsidiaries to compartmentalize the risk for each division. In the example of AIG, one small division, credit default swaps, will not take down the entire company, but that adds to the default risk of each of the individual subsidiaries. Does this sound familiar? The dramatic drop in interest rates could not be sustained, with the 10-year U.S. Treasury falling to a low of 2.06% in January of 2009. Who would want to lock in a 2.06% yield to maturity for 10 years? Well, remember that the current yield on the 10-year is now roughly 70 basis points. Finally, unemployment spiked from just over 4% in late 2007 to a peak of 9.9% at the end of 2009. Most economists believed it would take years to work the unemployment rate back below 5%. It would take 7 years to see that level. Danish physicist Niels Bohr is quoted as saying, "Prediction is very difficult, especially if it's about the future." This new normal series is a look at how things may change after we work through and get past this COVID-19 nightmare. Some of those changes may never happen, some will be short-term in nature, and others may be permanent. At the time they were made, most of these past new normal predictions seemed very logical. But looking back, it is clear that determining long-term changes is not without its difficulty. The goal of the investment committee here at Oakworth Capital Bank is to try to understand what changes are possible and make adjustments to our investment allocations to take advantages of the changing investment landscape. This is our view into the possible changes that are now underway.